We're going to start on time today, and this is being recorded, so if you come in late, that's okay. You can catch up to us. We're going to look at what's happening in the gold market, in the crude oil market in particular, and some of the driving factors and forces behind the activity in those markets. And we're going to try to figure out what the smart money is doing, if we can also be smart and do what they're doing. So we're going to get into some introductions here. But first, let's take a look at the risk disclosure. Keep in mind that there is always risk of loss when trading. You should be using risk capital, and that past performance is never a guarantee of future results. So take a moment and get a screen capture of that or a picture of that. You can read all the words to that risk disclosure if you'd like. A little bit about who we are. We are Altivest. Since 1997, we're located in California. 28 years now, it looks like, serving clients. We've traded millions of contracts along the way. A little bit more about us. We're registered with the CFTC. We're a member of the NFA, and we're located in California. And I am your co-host. My name is Eric Gebhard, and I have my Series 3 license from way back in 1991, if you can believe that, right out of school. And I graduated from University of Southern California with my BS in Business Administration. Then I'm joined today by, and we can allow Mike here to introduce himself.
Yeah, hello everyone. Yes, Eric and I started Altivest in, I guess that was 97, and
Right.
got my Series 3 a few years after Eric did in 93, and I went to Kansas. So, um, but yeah, so let's get going.
Okay. So maybe you've seen some of our presentations before. We do a lot of internet content, a lot of webinars. We used to do a lot of things live and in person as well. In fact, this picture here was from just last year in Miami. We did a big event there. They said there were 1,000 people in the audience. So we spoke at that event. That was a lot of fun. And actually, Mike, you can comment on this one here.
Oh yeah, Market Watch likes to ask us about the gold market, and I think this was from June 10. It looks like a week or so ago. They were asking us what was going on with gold, and so we gave them some comments. But I think the main thing is that we've been expecting gold to be in kind of a weak period through the end of this month, and that has to do with some macro considerations that we'll touch on in a little bit here.
Right.
So we're kind of getting set up for what we think is going to be a rally in gold in the coming months.
Yep. Very good. Okay. So here are some of those factors, the larger landscape, kind of pulling back and looking at some of the, I guess, larger influences here and the key factors for gold: inflation, economic growth, government spending, overspending there, monetary policy, essentially money printing, and central bank demand. In fact, all these factors are important, but we're going to touch on, I guess, all of them to some degree. And maybe looks like Mike, you want to comment on this first slide here on inflation and
Sure.
growth.
Yeah, when it comes to the gold market, this is we subscribe to Hedgeye, and we kind of their quad model is a good kind of weather forecast for us when it comes to the gold market. And so they've got a couple of different, four different macro regimes, quad one, two, three, and four. And let's see here. So, and then in two of them, the quad three and four tend to be pretty bullish for gold. Um, and the commonality there between those is you've got a deceleration in economic growth. So if economic growth goes from 2.5% to 2.3%, that is a rate of change deceleration. And so that means that you're going to be in one of those quads depending on whether inflation is accelerating or decelerating. So what's interesting is most people think of inflation as kind of the primary factor for gold, but when you get into these macro regimes, the common element tends to be a deceleration in growth because if you think about it, the Fed is going to be leaning more dovish if the economy is struggling. So that
Hmm.
their back tests show that gold tends to do really well. And in the third quarter of this year, Hedgeye is forecasting a deceleration in growth. So the macro setup is positive. The Q, the quarter that we're just ending right now is actually a quad two scenario, and so you can see that that is actually where gold doesn't behave well at all. It tends to struggle, and that's exactly what has happened
Right. Right.
recently.
Yeah, absolutely. We're seeing that. So essentially, a more dovish environment suggests there's less competition for interest in gold, I guess is one way to look at it. All right. So here's a little bit on the government overspending. And I think the key to this here would be talking about uh, spending here 7 trillion, only taking in 5 trillion, resulting in a 40% deficit and overspending. They have a significant amount of debt to finance, and the demand for that debt is falling. And we're going to see that in just a few slides here. So the decline in demand is driven by a standard supply demand factors as well as fears from debt holders regarding potential sanctions.
Yep, and
And yep,
just a quick comment on that. So when he's talking about demand falling, he's talking about international other countries and their currency reserves historically would invest in U.S. debt, dollar-denominated debt, but they're not doing that as much anymore.
right.
And so the Fed, Federal Reserve, is basically the buyer of last resort to bridge the gap, so to speak. And so they just print dollars to buy the difference, so to speak.
Right. And speaking of printing dollars, this is sort of representing here on this chart, the more they print, the less valuable those dollars become. So you're inflating the money supply and it's eroding the purchasing power of the dollar. And so if you're an investor, whether you're a small investor or a sovereign wealth fund or institution or government or what have you, you don't want to be stuck holding depreciating dollars. That's kind of the landscape here that we're looking at. And here's Milton Friedman, economist. If you're not familiar with him, you could definitely look him up. And he has a lot of wise things to say, but he points out that inflation is made in Washington because that's who can create money. So when you talk about price inflation, it really starts with currency inflation or the inflation of the currency supply. So too much government spending, too much government creation of money. So that's the whole cause behind price increases. And he is talking about I'm sorry, not he is Alan Greenspan, the former Fed chairman, talking about gold and how it's a good investment. He's talking about gold being a currency. It's no fiat currency, including the dollar, can match it. So very insightful, short and concise comments there. Something to keep in mind. We talked about central banks, or we didn't talk about central banks. But we did talk about how they're actually sort of rotating out of treasuries and into gold, and we're going to look at that in a chart or two here. But it says here in 2026, the World Gold Council just completed um, let's see, a survey here about gold reserves. So you want to make a comment on this one, Mike?
Yeah, the World Gold Council does a lot of good work on gold demand, and they just a few days ago published the results of this survey. They went around and surveyed a bunch of, I think it was 90 or 94 central banks around the world,
Mm-hmm.
and they're basically saying, what proportion of total reserves do you think will be denominated in gold 5 years from now? Um, and so, their responses in blue is 2026, and you can see each, it's moving higher every year, more and more, moderately higher. They're going to increase their exposure to gold um, versus, versus unchanged, and there's hardly any. Uh, Nobody's saying significantly lower, and it looks like there's just a small percentage moderately lower.
Yeah. Okay. And I think there's another graph here
Yeah,
where
there's a few of them
yeah,
here.
it's kind
Uh,
of saying
oh,
the same thing.
yeah, so kind of this time they're asking, about dollars. So it's clear that the shift is towards holding fewer dollar-denominated assets, in other words, U.S. Treasuries. Um, and so shifting out of treasuries into gold.
Right.
That's a common theme.
Here's another way of looking at it.
So yeah, so even instead of going out 5 years, just over the next 12 months, now in 2026, you've got that's 89% expect an increase in their gold reserves,
Right.
11% unchanged, and nobody's reducing. And then
Over the next 12
let's see.
months.
Um, yeah, so it's kind of the same story.
Hmm.
Over the next 12 months, they're 45% increasing, 50% unchanged, and it looks like there is 1% decreasing. And I think around the Middle East war, I think there may have been some central banks that sold some gold for they needed dollars for that situation.
Hmm.
But maybe that's what's happening there. I don't know.
And then China is buying gold again here. Official gold
Yep.
purchases picking up in May. People's Bank of China reported gold purchases and gold's share of total foreign exchange reserves. So
Looks like
they're,
they like lower prices. They
yeah,
the
they
lower
waited it.
prices.
They waited out. Yeah.
Yeah.
And then here's just the global central bank landscape, not just China, but you've got biggest buyers of gold. You've got Poland and Turkey, so Eastern Europe and Asia. So despite the poor performance, or maybe because of it, central banks are piling into gold. Here's another graph looking at basically the same thing here. They're resuming their gold purchases here, the blue bars here in April. And then that's kind of at the expense of the US Treasury market. So you can see here long-term US Treasuries versus gold, kind of a ratio here. So the demand for the Treasuries is decreasing while the gold demand is increasing. So trust is evaporating. Gold is becoming a preferred reserve asset. Here's another look at it, talking about gold overtaking US Treasuries as the world's largest foreign reserve asset in 2026. And here's what it looks like here on a graph. You can see they're kind of moving the up here when you have the treasuries versus gold. So gold reserves hitting 5 trillion, overtaking US treasuries as the world's top reserve asset. So I think that picture sort of speaks for itself. And then this is interesting too. If you're not really fully aware of the size of the gold market, it's by far the largest asset class in the world. This was, as of yesterday, 36 trillion value there in gold. You've got Nvidia down about 5 trillion, and I believe, where was SpaceX here? I think it's, yeah, there it is. So it's already, isn't that amazing? After 4 days on the market, SpaceX is in the top 10. But anyway,
But
gold
but
still,
they're only
yeah,
trading, I think, 5% of the float of those shares. So
that's right.
that'll be interesting.
Oh boy. Okay. So here, gold is here's a comment here, gold being the perfect reserve asset. And when you look at it, when you take the commodities and you price them in dollars, you'll see that everything gets more expensive because your supply of dollars is inflated and erodes the purchasing power. But this was interesting. If you price commodities in gold, then those actually the prices of those commodities actually become cheaper. So that's kind of an interesting way to look at things. However you denominate something makes a big difference in the end result. And here's what gold looks like on a graph. I don't know if there's anything, any other thoughts or comments on the chart there?
Yeah, I mean this is a monthly chart, so every bar represents a month. And so, like I was saying a little earlier, in quarter 2 that we just finished was a what we call a quad 2 quarter for in the U.S. And that is a negative macro environment for gold, and it just lines up pretty perfectly with this correction we've had. If you're a technician, might notice that you've had a 38% retracement. We've come down and touched that level a few
Right,
times, but the macro is shifting, and the weather forecast looks a little sunnier going into quarter 3 this year.
right. Okay. And here's a daily chart on gold, and you've got a couple signals here with the RSI.
Yeah, that's, it seems this is a technical indicator. It seems to work pretty well in the gold market. It's not that often that you'll see a daily RSI in gold get oversold, but when it does, it's usually a pretty reliable buy indicator.
Right. So anything below the 30 level would be considered oversold. It doesn't mean it's going to rally. It just might mean there's a change in trend or some
Right.
consolidation. But you can look back here in October and then never quite got that deeply oversold again. Doesn't really happen often, but when it does, it tends to be a pretty good signal, at least on this graph. Going back 2 years, it looks like about
Yep.
2 years. So something to be aware of. And this is a comment here that I think it's sort of counterintuitive at times because if you think about it, this guy pointed out the obvious here. He says, "I've made more money sitting in gold than in owning the S&P 500 over a 1 year, 2 year, 5 year, 10 year, and 20 year period." And looking back at gold in the last, I know in 2025, gold was the best performing asset and so forth. So sometimes we just sort of get caught up in the headlines, and gold tends to fly under the radar. But something to keep in mind, and he's predicting gold to 10 and 25,000, and who's to say? Hard to put a price target on things, but I guess just not many years ago we were trading gold and it was $400 or less, and then it went over 5,000. So these things do happen sometimes right in front of our face. So to summarize gold, central banks signaling more gold purchases. The BRICS continue to de-dollarize and sell their foreign reserves in favor of gold. Wall Street banks, this is interesting too, formally added gold to their model portfolios. So they're no longer looking at that 60-40 traditional stock and bond portfolio. They're actually moving 20% into gold. And along the way, U.S. budget deficits are rising, and that's kind of driving, I guess you could say, some of that behavior. And the Federal Reserve's continuing to monetize the U.S. debt by just creating dollars. So how about let's look at some gold contracts and how it actually works if you want to trade futures and futures options. And there are various contract sizes, anywhere from 1 ounce to 10 to 50 to 100 ounces available to trade. And we'll look at a couple of examples. Here's a 1 ounce futures contract. They call it taking a small bite here. But for example, if gold were trading at $5,000, capital required is $390. So you kind of have a 13-to-1 efficiency ratio, is what the CME group calls it. You compare that to just taking an outright position in an ETF or even just buying physical gold. If you want to buy $5,000 worth of gold, well, you have to have $5,000. So your efficiency is 1-to-1. So there's 13 times greater, I guess you could say, efficiency, or you might want to use the word leverage. And of course, it can work for you or against you. But the point is to have a position in $5,000 worth of gold. If you're trading a 1 ounce futures contract, you need less than $400 in this example. And just more of the same here. Looking at a 1 ounce, looking at a 10 ounce, 50 ounce, 100 ounce. So, you definitely have people trading 1 ounce contracts all the way up to the 100 ounce contracts. So it just depends on how much risk capital you have. Any other comment on that, Mike?
No, I mean it's nice. We've got a broad array of different size contracts, so we can, size them for someone's account and have the appropriate amount of leverage.
Right. And of course, there are options available. We tend to buy options and trade options on the full size contract. But in any case, we can talk to you more about that. So you have the GLD ETF versus a micro gold contract. And let's say gold's trading at $4,300. You want to walk us through this real few bullet points here?
Yeah, just like you were saying earlier, if you're buying the ETF, it's 1-to-1, so $15,000 invested in the ETF, controls $15,000 of gold. And so if somebody had $15,000 in a futures contract and an appropriate amount of leverage with margin of 2169 $2,169 for a micro contract, which is 10 ounces.
Hmm.
You're controlling $43,000 worth of gold as opposed to $15,000 in the GLD, so with a reasonable amount of leverage. So there's the difference.
Right. Right. And so then if you have the underlying price move up, a certain percentage or move down a certain percentage, then they'll have a much larger impact on your micro gold position, versus an ETF in terms
Right,
of the percentage move or how much it means to your account up or down.
right.
All right.
Yep.
So that's a little bit for gold. Now we're going to look at crude oil. Obviously, crude oil has been making headlines of late, in the last 3, 4 months in particular. And here's one key thing to keep in mind: the the start of the war there in Iran, or the conflict, whatever you want to call it. You saw crude oil prices moving higher, and then they've been kind of, I guess you could say, falling off and retreating along the way, and people have been scratching their heads as to why that can be if such a large supply of the global, crude oil market has been shut down through the Strait of Hormuz there. Well, the answer is really, we have been depleting our strategic petroleum reserve to keep prices reasonable, and a lot of other countries have been doing the same with their reserves, and in particular China as well. But at the same time, no, there's a price to pay for that. Is we now have 41-year low stockpile of our petroleum reserves. So you can see it on the graph that kind of speaks for itself. And here's another graph kind of referencing the same thing, but just slightly different time frame.
Yeah, this is referring specifically to the Strategic Petroleum Reserve. So as of last Friday, that reserve had fallen to 340 million barrels, which is below that prior low that's on that chart of July 7, 2023, when it was at 347. We had built it back up to 415, but just as of March of this year, but it's just fallen off a cliff.
Hmm.
And actually, we have been exporting oil out of our SPR to places like Europe and some parts of Asia to keep them from running out. So
Right.
that's been, I mean, we've been seeing 17 million barrel draws a week when you combine the draws from the SPR and the commercial inventories, which are separate categories um, out of the US. So, um, yeah, so, the minimum level isn't zero in the SPR. It's actually about 250 million barrels because, according to a study back in the 70s, it was estimated that if you got below 250 million barrels, then the salt caverns that the SPR oil is stored in risk structural collapse, and then
Right.
it'd just be unusable. So we're at 340 to 250. We're 90 million barrels of SPR oil really before we kind of hit the bottom of that available supply.
All right. So here's a post sort of referencing what we just talked about there, talking about U.S. inventories reaching lowest levels since 1985. And the EIA reported U.S. crude oil inventories plunged by 8.3 million barrels last week. So
Yep.
as the
And that
inventories, or go ahead.
I was just going to say, and that's specifically referring to the commercial inventories, not the SPR, but they
Right.
both fell about the same amount.
Right. And then, kind of something that is obvious, but you kind of have to think about it really, is the the reserves are kind of near their bottom. Their functional or practical bottom, and they have to be refilled. So uh, that's what they're talking about here. These inventories are going to have to be replenished, and then that's going to uh, lift oil prices as that happens. So we'll see. But
Yeah.
this guy here, he's very bullish. He's been bullish even though we've pulled back off of that recent spike. And
And he's an economist at Johns Hopkins University.
Yeah,
He's
Stephen Hank.
noted. Yeah,
And talking about the Cushing, Oklahoma commercial stockpiles hitting what they call tank bottom.
yeah.
So
So
I think
those
that
that was as of Friday. The operational bottom is around the 2021 million barrel level in Cushing. Cushing is the largest commercial oil storage pad in the country, um,
right.
and they supply a lot of the refiners. So they are now at, they really can't go any lower. Uh,
Yeah, they're at their limit. It
right,
was kind of interesting yesterday. People were commenting about President Trump, his comment saying, "Well, we're going to run out of reserves in about 4 weeks."
right,
So
yeah. Well,
I
that
guess he was motivated to get a deal done.
yeah, absolutely,
Yeah,
absolutely. So
yeah. Anyway, I guess it wasn't really a secret. So, but anyway, what about this chart here? What can you comment here
yeah.
about this chart?
So Giovanni put out this chart, and he's talking about their refinery utilization rate um, is really, basically the refineries are running near almost 100%. And so we're refining as much oil as possible into, gasoline and other things, but we still had a 300,000 barrel draw, or no, excuse me, 900,000 barrel draw in gasoline supplies last week, even though refineries are running flat out. So as far as, a lot of people are saying, oh, there's demand destruction, that's why oil hasn't gone up. Well, you know, in terms of gasoline demand, I don't see the demand destruction at all. And I think what people are saying, or what's happening is just, we just haven't had a shortage yet. That's, people aren't seeing the tight supplies. They're not seeing, I'm sorry, we have no gas, or, whatever. So
Yeah.
yeah,
Well, we're just running through the reserves to keep a good facade going.
right.
That's kind of what's happening. And then here's a graph here of oil. Pretty
Yep.
simple graph, nothing really analytical about it, but you can see the run
Yeah.
up here.
Yeah, and the latest little downdraft, I think there are a lot of, you got fundamental people that have been pounding the table about the oil inventory data, but then you also have very mechanical traders and systems that see a trend break and they sell. They don't care about fundamentals, they don't care about oil inventory data. Market rolls over, and that's their sell signal, so they sell. They are mechanical sellers. So, if you ask the question, well, why with all this bullish information would anybody sell this market? Well, there are mechanical sellers, and those mechanical sellers may turn into mechanical buyers should prices start to rebound.
Right. Okay. So some of the key factors for oil, just to kind of keep in mind, and let's take a look at these real quickly. We don't have to read every word, but uh, yesterday the memorandum of understanding there with Iran to open up the straits. And we mentioned this earlier here just a minute ago. Trump admitted we were 4 weeks away from running out of of oil. And then how long does it take for the oil flows out of the straits to normalize? Actually, you're getting opinions on that, but they all seem to suggest it takes many, many months. It's not just something that happens in a few days. And so, will will the U.S. experience shortages before Mideast supplies reach North America? And does the oil market need to see a shortage before prices react? So, kind of talking about demand destruction there, I guess. That's what that means really. So if prices react, then that's actually the cure for um, the cure for what they say. The cure for high prices is high prices. So
And
um,
the cure for high demand is higher prices.
higher prices. There you go. And then here, talking about will the U.S. slow its exports? The U.S. has been exporting its SPR oil to Europe and Asia. How aggressively will China and Asia buy oil? They've been absent from the oil market since the Iran war started. They normally buy 5 million barrels a day, but they relied on its 1.4 billion SPR to keep its domestic market supplied. So yeah, their SPR reserve is what, triple what ours is? Is that or
Yeah, quite a
more,
bit, even
more,
much more than that. Yeah.
more
So
than that?
quite, at least quadruple.
Yeah, well, they're a much bigger country, I guess. But long-term global SPR rebuilding is likely to keep a strong bid under the prices. So yeah, that's kind of, we just suggested that earlier, that that has to be bought and has to actually physically replenish those supplies. So you're going to have a big buyer kind of always wanting to buy every dip. So along the way, but so, and then also, will Israel get in the way of a Middle East peace? Who knows? There's still a lot going on in Lebanon, and there's still um, it's not necessarily that peaceful. There's
Yeah.
still
Well,
some fighting going on.
we wrote this yesterday, and we're seeing headlines today already that Iran is threatening to reclose the strait because of Lebanon, what's going on there. So,
Right.
you know, who knows if that happens? Um, yeah. So it's
All right.
interesting.
Well, and we did touch on gold, and we touched on crude oil, kind of the two uh, headline making markets of late. But as a brokerage firm, keep in mind we can trade any commodity market, any futures and options market, not just gold and oil. And we trade stock indexes and everything along the way.
Yeah. And Eric, I would just a quick comment on, when we're talking about gold, and a lot of it being driven by, deficits and money printing. I mean, this is a long-term problem, and likely a long-term bull market. Whereas the oil market, we were talking about this earlier. I mean, that has the potential for a sharp spike, but not the same type of situation. Ultimately, we're probably going to get a supply situation worked out, and things will eventually get flowing again, and so on and so forth. So it's more of a near-term opportunity that maybe an options play would be appropriate versus gold, which you could have an allocation to futures contracts and so on.
Hmm.
So
Yeah, in fact, some people are commenting that if the agreement holds, over time the market will, I suppose, get more comfortable with the agreement, and the fact that sort of the wild card with Iran is somewhat off the table, and that might help keep oil prices suppressed in the future. But in the very near term, it's still a very erratic and volatile scenario for sure. And there are some bullish forces in the very near term that could create a nice price spike. And it would be nice if actually you're positioned correctly, but otherwise not so nice.
right,
um,
it's yeah, it's a lot of things have to go right for you know, or let's just say a lot of things could go wrong.
yeah, for sure. And then, so if you want to get involved with gold and crude oil or any other futures or commodities market or options market, you can certainly do that. We offer private coaching and trading plans. That's what we do. That's part of what we do. We're all licensed and experienced here. So we'll set up an appointment. We'll share our screen with you and kind of review a trading plan for you. um, Really, everyone's different. Everyone has different amounts of risk capital, different goals. We have some people that have been trading with us and they just buy gold and silver and roll it over every few months, and they've been doing that for decades. And other people that only like agriculture, and other people that are only doing stock index options trading and premium collection and so on and so forth. So we can put together a plan for you. And one advantage with futures is it is a tax efficient environment. So all futures and futures options offer tax efficiency. So what I mean by that is the IRS treats your gains in a favorable manner, with 60% of those gains taxed at the longer term capital gains rate, and 40% at your personal income tax rate, which is, of course, typically higher than the um, capital gains rate. So you end up with tax efficiency and some tax savings there. And also, a big advantage, you get that P&L at the end of the year on your 1099. So you just use that one number to do your taxes. You don't have to do any itemizing or wash sales or anything like that, like you might do with securities. You don't end up like this guy here, buried with paperwork. So always consult your tax attorney or advisor for details on that. And of course, keep in mind you can use a self-directed IRA when you're trading futures as well. And there's plenty of articles around how to do that, but this was one a few years back talking about the market volatility, investing in alternative assets through a self-directed IRA. So combating market volatility. I think there's a lot of truth to that. You can have alternatives and exposure to markets in a self-directed IRA that maybe you weren't thinking about in the past. And Equity Trust is who we work with, and they have this was actually a few months back, but 71 billion in assets under custody. So that's who we work with, and you tell them you're with Altivest, and they will waive their setup fee. So we can definitely get you started with an IRA if that's something you want to use. So IRA, individual account, joint account, you can do anything like a corporate or LLC, trust accounts, any of the above. And so this is how to get started. You just basically go use this QR code, or you can call us, or you can email us, or you can go directly to the link there and just enter your info and say, saw your presentation, give me a ring. I'd like to talk to you more about doing XYZ and whatever it may be, and we'll be glad to chat with you. So I think that's going to wrap it up. And do you have any other final thoughts or comments, Mike?
Nope, I think we covered it. And thank you for joining us. And we look forward to hearing from you. And we're happy to give you, if you have any other questions about these markets, happy to discuss and give you our thoughts.
Yep, very good. Okay. Thanks everyone for joining us, and we hope to hear from you soon. All right. Bye bye.
Bye bye.